When you travel to another country and exchange your home currency for the local cash, you are participating in the foreign exchange market. Now, scale that simple transaction up to a massive, decentralized global network. Operating 24 hours a day, Forex processes over $6 trillion in volume daily, making it the most liquid financial market on Earth. But the mechanics here differ from buying stocks. When you buy shares, you pay a static dollar price for a piece of a company. In Forex, there is no static baseline. You're constantly weighing the floating value of one nation's currency against another. Trading here means you are taking a calculated position on the relative economic strength of competing countries. Every digital trade is ultimately tethered to actual physical economies, represented by the very banknotes used by billions of citizens. You are never evaluating an absolute number. You are evaluating a ratio, a continuous difference in strength between two massive sovereign systems. Because we measure relative strength, you can't trade a single currency in isolation. The system requires a pair. Take the euro and US dollar. The left currency is always the base, the right is the quote. If USD equals 1.10, that equation dictates exactly how much of the quote currency is required to purchase one single unit of the base currency. 1 euro costs $1.10. This creates a counterintuitive dynamic on the charts. If the US dollar, the quote currency, suddenly strengthens in the real world, the physical line on the EUR/USD chart will actually fall because it now takes fewer dollars to buy that euro. This diagram lays out your two execution paths. You enter a long buy position when you forecast the base currency will appreciate, profiting on the upward distance. Conversely, evo short, a sell, when projecting the base will depreciate, profiting as the chart moves downward. Regardless of the direction you choose, the broker executing the trade will charge a spread. This is the fractional gap between the buy and sell price at any given millisecond, the built-in cost of accessing the market. Placing a trade is an intricate macroeconomic forecast. You are simultaneously projecting the rise of one economy and the relative decline of another. To understand when these trades happen, we have to look at the geography of the market. This world map outlines the staggered operating hours of the four major financial centers. While the market remains open 24 hours a day, 5 days a week, the efficiency of that market fluctuates wildly. The green gradient beneath these sessions shows how trading volume, the actual depth of the market, swells and contracts throughout the day. The global cycle kicks off in the Asia-Pacific region, driving initial volume through hubs like Tokyo and Sydney. But the vast majority of institutional capital enters the system later, driven by Western financial giants in Europe and the Americas. The highest trading volume occurs during specific inflection points, session overlaps. This chart aligns daily trading volume peaks directly beneath the times when major time zones run simultaneously. The most critical lingo of the day is the London and New York overlap. During these specific hours, the world's two largest financial hubs are actively trading at the exact same time. This mathematical reality creates maximum liquidity, injecting deep volatility into the charts and compressing broker spreads to their absolute tightest. So the idea that Forex is a flat, continuous 24-hour market is a myth. The rotation of the Earth dictates market efficiency, meaning when you enter the market carries the exact same weight as what you decide to trade. But what actually causes these currencies to move in the first place? Price action is driven by underlying macroeconomic realities occurring inside those borders. Traders constantly monitor a nation's interest rates, its inflation metrics, and its overall domestic production and economic growth. If a central bank announces a hike in interest rates, international capital typically flows toward that higher yield, pulling the value of that nation's currency upward. Yet, despite trillions of dollars exchanging hands, the daily price fluctuations between major global currencies are remarkably tight, often moving by fractions of a single cent. To make microscopic movements profitable, brokers employ a mechanism called leverage. It acts as a financial multiplier. By putting down a tiny fraction of the total value, say $1,000, a trader controls a position worth 10, 50, or 100 times that amount. This allows for massive upside potential on fractional price movements. However, it introduces an asymmetric risk profile. While profits are multiplied, loss exposure scales at the exact same velocity. Leverage transforms what would otherwise be a slow, stable macroeconomic metric into a highly volatile, high-stakes retail asset. When you combine all these elements, the true architecture of Forex reveals itself. It is the ultimate global valuation engine, constantly assessing the health of competing nations in real time. You are trading relative data, bound together in strict pairs. You are executing those trades inside a rotating geography of global liquidity. And most importantly, you are navigating those fluctuations using amplified financial instruments. Because of leverage, technical chart analysis is completely useless without an ironclad system for risk management. Misunderstanding how leverage multiplies exposure is the mathematical reason the vast majority of new retail traders lose their capital. Forex provides unparalleled access to global capital flows, but you only survive in this system if you protect your downside first.